All right, let's dive into this deep dive. Today we're talking about intelligent investing. You sent over some really interesting stuff from Benjamin Graham's The Intelligent Investor, kind of a classic, right?
Oh, yeah, definitely a must read for anyone serious about investing. And you've also got Jason Zweig's commentary from his updated version, which is great.
Yeah, I mean, to have those two perspectives, it's like a bridge between like old school wisdom and how those ideas still work today, in our crazy market.
Absolutely. I mean, Graham was writing way before all this tech stuff exploded.
Right. So much has changed, but like how much is still relevant? That's what I'm curious about. What do you think?
You hit the nail on the head. Our mission, if you will, is to figure that out.
Hmm.
What are those core principles Graham laid out, the ones that are supposed to help you pick good companies? And then, like, how does Zweig see them playing out now?
Yeah, it's like time traveling investment advice.
Love that. But yeah, Graham was writing in a totally different world. Everything was slower, no instant information, no algorithms trading a million shares a second.
Right, totally different game.
Exactly. So he was all about figuring out the true value of a company, like what's it really worth beyond the hype.
Okay, so where do you even begin with that? It sounds kind of intimidating, honestly.
Well, he really emphasizes looking at the long-term prospects of a company, not just like next quarter's earnings. You know what I mean?
So not getting caught up in the short-term stuff like the flavor of the month kind of thing.
Exactly. He wants you to understand what makes a company grow sustainably over years, not just a quick spike. Like, think about a company spending a ton on research and development.
Oh yeah, like investing in the future.
Right. That's vital for innovation, for future growth, but it might not show up as profit right away. Graham wants you to see past those immediate numbers and get the big picture.
Hmm, that's a good point. It's like, you know, not judging a tree just by the fruit it has right now, but also like the roots, how healthy it is, how much potential it has, right?
Perfect analogy. It's about understanding the underlying drivers of a business.
So that's one big piece. What else should we be on the lookout for?
Another crucial thing is management quality. Are the people running the company good stewards of, well, everything, including your money if you invest?
Yeah, I mean, you hear stories about CEOs who are like all talk and no action, or worse, they're doing shady stuff behind the scenes.
And that's exactly what Graham's warning against. Don't just take their word for it. Look at their actions. Like if they're constantly selling off their stock while telling you to buy.
Ooh, yeah, that's a major red flag. Run away.
Exactly. Actions speak louder than words, always. And then, of course, there's financial strength. Can the company handle tough times? A simple way to check this is the current ratio, which compares assets to liabilities. Ideally, you want at least 2 to 1, meaning they've got twice as much stuff they own compared to what they owe.
Okay, that makes sense. It's like having a financial cushion, right?
Precisely. It's about making sure the company's on solid ground, they can weather some storms.
Makes sense. Now, Graham also seems to talk a lot about dividends. Why are those so important? I mean, they're nice to get, but is there something deeper there?
He loved dividends, especially if they were consistent. It's like proof that the company is making real money and they're willing to share it with you, the owner.
Hmm. So it's not just about the money itself, but what it says about the company.
Exactly. Like they're stable, they respect their shareholders, good management, thinking long term. Now, the current dividend rate, the percentage you get based on the stock price, that can be tricky, especially with growth companies. They might reinvest profits instead to grow even faster. But for someone who wants stability, income,
Hmm.
those steady dividends are great.
Okay, starting to see the picture here.
Yeah.
But how do we put this all into practice? Like, how did Graham actually use these ideas to pick stocks?
Well, he gives us some really cool case studies. In the book, he looks at 4 companies from way back, 1970, all listed on the New York Stock Exchange. And this is where it gets interesting. 2 of them, on the surface, they were like the boring ones, but they ended up doing amazingly well over the long haul.
Really? So, like, even if a company owns valuable land, has a famous name, it doesn't guarantee anything.
Exactly. It can all be worthless if they're mismanaged, burning through cash. That's where analyzing their financials, like we talked about, becomes your job.
Okay, now I'm really intrigued. Let's hear about these companies. I gotta know how this all played out.
Absolutely. Let's get into those case studies and see what secrets they reveal.
All right, lay it on me. What were these companies Graham was looking at?
Okay, so 2 of them, these were like the hot stocks back then, Emerson Electric and Emery Air Freight. They had like really high price to earnings ratios.
Price to earnings meaning,
Oh, right, sorry. It means investors were paying a lot for each dollar of profit the companies were making. Like they had high expectations for growth.
Gotcha. So the market was betting big on these two.
Yep. And then you had the other two, Eltra and Emhart. Kind of boring companies, made electrical parts, fasteners, that kind of stuff.
Not exactly the next Apple or Tesla, huh?
Nope. And their price-to-earnings ratios, way lower. The market wasn't nearly as excited about them. But, and here's the kicker, when Graham actually dug into their performance, it wasn't that different from the glamour stocks.
Wait, hold on. You're saying their growth, stability, all that, it was comparable.
Pretty much, yeah. Their financials were all pretty solid across the board.
So why was the market valuing them so differently? It doesn't make sense.
That's the thing, right? It gets to the heart of Graham's whole idea of glamour stocks versus value stocks. The market was so in love with the story of Emerson and Emery, the potential, they were willing to overpay. But that high price, it erodes your margin of safety.
Okay, you keep saying margin of safety, but I'm still not totally clear on what does that really mean when we're talking stocks?
It's huge, honestly. It means buying a stock at a price way below what Graham called its intrinsic value, what it's really worth. Think of it like this. You're buying a car, but it's on sale. It's the same car, but you're getting a deal, right?
Yeah, so something goes wrong, you're not out as much money. You got that cushion.
Exactly. So with those other two companies, Eltra and Emhart, their lower price-to-earnings ratios, it was like you were getting a bigger discount. More margin of safety built in.
Uh-huh. Okay, so even if the company IS great, paying too much for the stock makes it riskier.
That's Graham's point, yeah. You can't be right about the company but still lose money if you overpay. Now, here's the thing. We're talking about 1970. Does this stuff even apply today in our crazy tech-fueled world?
Yeah, that's what I'm wondering. Everything's so different now.
And that's where Jason Zweig comes in. He wanted to test Graham's ideas, but using companies from, like, the late 90s, early 2000s, the dot-com bubble.
Oh, man, the dot-com bubble. That was wild. Companies with, like, no profits were worth billions.
Total speculation. Everyone wanted to get rich quick.
Yeah.
So Zweig looked at 4 companies from that time.
Okay, I'm hooked. Tell me more. Which companies?
Well, he included Emerson Electric again to see how it did through that whole craziness. Then he added BMC Software, Exodus Communications, and Expeditors International. Kind of a mix, right?
Yeah, some tech, some not. I'm guessing the results were pretty interesting, given what we've been talking about.
Oh, incredibly insightful. Remember all that stuff about financial strength, looking at the balance sheet?
The 2-to-1 ratio, right? Assets versus liabilities.
Yes. Exodus Communications, they were like the poster child for what not to do. Burning cash, tons of debt, but traders only cared about the stock going up that day.
So they were ignoring the fundamentals, just buying on hype.
Totally. And guess what? Bubble bursts. Exodus goes bankrupt in 2001.
Oof, that's gotta hurt.
Hard lesson.
Yeah.
Yeah. Some things never change. Chase hype. Ignore the basics. You're going to have a bad time.
So what about the other companies Zweig looked at? Did any of them follow those Graham principles?
Expeditors International did. They were a logistics company, solid financials, good track record, not caught up in the dot-com frenzy. And they did great. Weathered the storm, kept delivering returns.
So even in all that chaos, sticking to the fundamentals worked.
It's powerful stuff. Even Emerson Electric, which was a glamour stock back in '70, by this point it was mature, good financials. They did fine too.
This is all fascinating, but I gotta be honest, it's a lot. For someone listening, like, where do they even start? How do you actually use this knowledge to make good investments?
Great question. And that's exactly what we're going to dig into next. Time to go from theory to practice,
Yeah, I mean, it's one thing to read about these, like, legendary investors, but it's another to actually, put it all into action myself. Where do I even begin?
It can feel overwhelming, for sure, but honestly, a lot of it boils down to common sense.
Common sense and a whole lot of research, I'm guessing.
Research is key, yeah. But it's not rocket science. Graham's all about cutting through the noise, focusing on what matters. Like, first step, become a financial detective.
Okay, Sherlock Holmes, here I come. But seriously, where do I look?
The SEC's Edgar database is your best friend. It's free, has all the company filings, financial reports. You can see the raw data, not someone else's interpretation.
Gotcha. So, like, going straight to the source.
Exactly. And when you're in those reports, pay close attention to cash flow from operations. Is it consistent? Is it growing? That's a good sign. And of course, check that balance sheet. More assets than liabilities, that 2-to-1 ratio we talked about.
Right, the safety net. What about the management team? How do you know if they're, like, actually good or just good at talking?
Look for signs they're in it for the long haul. Are they reinvesting profits, being smart with debt, Watch out for those non-recurring charges that keep recurring.
Oh, yeah, those are sneaky, like those hitting fees you find in the fine print.
Exactly. So yeah, research, digging deep, that's huge. But even then, it's tough to know what to buy, when to sell, right? The market's crazy.
Absolutely.
Yeah.
This is where understanding your risk tolerance comes in. Are you a defensive investor, wanting stability, steady income?
Mhm.
Or are you more enterprising, willing to take risks for potentially bigger rewards?
I guess I've never really thought about it that way. What am I?
That's something to figure out, for sure. Your strategy has to match you. If you freak out when the market tips, maybe a more conservative approach is better. But if you're okay with some ups and downs, and you're in it for the long haul, a little more risk might be fine.
Makes sense. But how do you avoid like those emotional decisions? We were talking about the dot-com bubble earlier, and it's easy to get swept up in the hype and make dumb choices, right?
Oh yeah, and this is where Graham's idea of Mr. Market is so helpful.
Mr. Market, who's that?
It's like a way to think about the market. Imagine this guy, he's manic depressive, super emotional. Every day he's offering to buy or sell your stocks, but at totally irrational prices based on his mood. Huh. Sounds like a bad roommate trying to trade you stuff when they're drunk.
Right. And the key is the intelligent investor, they don't play Mr. Market's game. They stick to their plan, focus on the real value, not the craziness.
So it's all about keeping a cool head.
I
Easier said than done, sometimes.
For sure. Few things can help. One, diversify. Don't put all your eggs in one basket. Different asset classes, industries, even different countries. If one thing goes bad, it doesn't wipe you out.
Right, spread the risk. What else?
Two, think long term. Don't try to time the market, chase quick wins, find good companies, hold on to them. Rome wasn't built in a day, and neither is a good portfolio.
Patience. Not about getting rich quick.
Exactly. And finally, this might be the most important: know yourself, your risk tolerance, your goals, even your emotional triggers. Like if you tend to panic sell, maybe a financial advisor would be helpful, someone to keep you on track.
Like having a coach in your corner.
Yeah.
Someone who can be like, hey, chill out. We got this.
Exactly, someone objective. Well, I think we've covered a lot today, huh? From those classic Graham principles all the way to how to actually use this stuff in a real world.
Yeah, this deep dive has been amazing. Really makes you think.
It's been a pleasure talking with you, and to whoever's listening out there. The journey to being a good investor, it never ends, right? Stay curious, keep learning.
Absolutely. And on that note, we'll leave you with something to think about. We've seen how the market can be irrational, all emotional. What signs have you noticed? Companies that seem overvalued or maybe hidden gems that are undervalued. Do your own deep dive, see what you find. Until next time, happy investing.